Yes, students. So we'll start with the next chapter called Ind AS 16. PP, you are homely, you are friendly. Okay, a small chapter, only 26, 24, 25 questions. And this is one thing what you have studied. But at a final level, what extra comes, that we will discuss here. So before I proceed, I would like to ask you, see, in Ramayana and Mahabharata, there is one thing common. You know, this Indrajit in Ramayana is a very powerful guy, very powerful. Nobody can defeat him. In fact, he almost killed Arjun. Not Lakshman. Now, this is in Ramayana. In Mahabharata, there is one more powerful guy called Karna. Nobody can defeat him. Arjun kills him. You know, in both the places, there is something common. What is common? In both these instances, there is one thing common. That is called Anjali Kastra. Both have been killed by the same weapon called Anjali Kastra. It's a very powerful weapon, students. Followed, no? That means nobody can stand in front of it. Such a powerful weapon. Now, this weapon was invented in the year 1940s. And that name of the weapon is called a little boy. You know what is little boy? And it was tried first on two cities. Hiroshima and Nagasaki. It's called atom bomb. It's like an Anjali Kastra, no? It can destroy. Nobody can stand in front of it. Finish. The world is going to get finished. Now my only question to you is, if Arjun had prepared a balance sheet, will he show Anjali Kastra as his asset? If USA is going to have a balance sheet, is this little boy shown as an asset? Is it an asset? What is an asset? Future use? Which is going to earn you cash in the future. That is an asset. Is this going to earn me cash? No. You know, if this Anjali Kastra, if I had, you know what can happen? Suppose I get this Anjali Kastra, very powerful weapon, nobody can stand. You know what could have been impact? Suppose 200 years back, I would have got this and I was born at that 200 or 500 years back. Today, irrespective of the religion, a person, everybody's house in the world would have had my photo. And every one of you would have treated me as a god. That's what I could have done. I would have destroyed anyone who will not listen to me. I sitting here, I say, go and give me cash here. No, chalo, from here only I'll shoot one arrow, I'll kill. Nobody in the world can stand in front of me. That's the power. No? That's why Rakshasas were doing tapasya. Give me the power. And with this power, am I not going to get the cash? Arre Papa, what cash? I am going to get everything. I just asked it. It's going to come in front of me. No, I'll shoot the fire. I'll fire it. So don't I get one godly status? Don't I people see me be afraid? And with that wealth, what I can do? Why I want to gather that wealth? What I can do? I will help everyone. On one side, I will show my terrific face. Terrible face. God also like that, no? On one side, God is very terrible. That's why we are afraid of God. On another side, God is so loving. On the other side, I am so generous that whatever wealth I got, I distribute to everyone. That's why you see a 50-50 there. God. I would have become, no? See, it's not that you will treat me as a God because I am terrible. Since at the same time I am generous also, you will treat me like a God. That's what I could have done with this weapon. Is it not my asset? Don't you wish you should have had this? Okay. Can I recognize it? It's an asset. That's why anything first should pass through the one definition of an asset. It's an asset, but can I recognize? Why? Can USA recognize? Yeah, because maybe this cannot be recognized as an asset. It is an asset, but you can't recognize in your books of account. This is also an asset, but it can be recognized as an asset. Why? Because the cost of this cannot be measured. He did tapasya. What is the cost of that tapasya? No. Here, you set up one project, you appointed the people, you paid them the salary, you got this uranium. You know your cost measurement very clearly. That's why you are able to recognize it. Just because you didn't recognize something is not an asset, you can't say that. Reality, you have to see what it is. Is it a tangible asset or is it an intangible asset? Then appropriate standards you need to apply. Followed? So now what is the principles which guides me to recognize this in my books so that people trust it? Tomorrow I can take my balance sheet. Arjun can take his balance sheet, but in balance sheet there is no asset. Can he get a loan? No, because balance sheet is, but if just because it's not appearing in the balance sheet, is it not available in the reality? It is there. See, that's why we have to think, students. Should I give disclosures there? That is accounting. Followed, no? Anyhow, let us learn about this particular. Okay, what we are going to learn? We are just going to learn 4 aspects. That's it. With this, we are done with this chapter. A simple, beautiful chapter. We are going to learn about the recognition and measurement principle. Just now I give the example. What I should recognize, what should I not recognize? Now the brand, is it an asset? Yes. Should I recognize? Maybe, but not here. So, examination questions are going to come in such a way for you that they will give you case and they ask, how do you account it? Now we have to apply the definition of lease. We have to apply the definition of revenue. You have to apply the definition of your 38. Apply the definition and see what exactly it is. Because it can be accounted by some other standard, no? So that is a skill you should be getting eventually, because that is what is expected in the upcoming exams. See, our time, 20 years back, 2007, 17 years back I can say, when I was writing exam, we had accounting standards. We had got auditing and assurance standard. Simple one-line questions there. What all the factors you consider while taking management representation? Today the questions are not like that. Accounting, Ind AS, all these things were not there only, what I am teaching you. Ours was accounting standard, what you study in inter-level now. Life was simple. But today, see, you understood that this is the need today, because people are falling out there. So, what you need to acquire is more understanding about this so that you understand tomorrow how to bifurcate things, look into things very clearly. We will talk something new about component accounting, subsequent measurement is easy, and the very beautiful thing called decommissioning liability. Okay, so let us understand the theoretical part of this. Now, property, plant and equipment, the first item in your balance sheet on the asset side. So, what is the property, plant and equipment? They are tangible assets. Yes, it should be tangible. That means seen, you can touch it, okay, you can feel it. Why you are purchased? You are held for use in the production or supply of goods or services. That means you are going to use that tangible to do the production or to do the supply if you are into trading or your service. For rental to others. Now, whom? Rental to your employees. If you are holding that tangible property for renting it to the third party, it will be considered as an investment property. Ind AS 40 becomes applicable for the same property. But if you are renting it to your employees, why you rented? Because you want their employees to do your manufacturing process. That's why it becomes a PPE now. Same house. Or for your administrative purposes. And more importantly, it is expected to be stayed with you for more than 1 year, because if it's less than 1 year, entire expense you would have charged to the P&L account. Since it is more than, you're going to split it into more than 2 years. So this is the definition of a property, plant and equipment. Now, should I recognize that? That depends upon 2 conditions. Recognition. Or when should I recognize? When should I recognize the financial instrument? When I become party to it. When should I recognize the financial property, plant and equipment? The cost, not a fair value. Understand? Financial assets or liability will be at a fair value. Here it is at a cost of the PPE, which is nothing but a tangible item, which is more than 1 year. Recognized as an asset only if you are going to get the future economic benefits. If you are not good, there is a tangible asset, but it's not going to get future economic benefit, you have to go to scrap it or don't recognize it only. It's not your asset. Like I have got an atom bomb, but the atoms in it has got expired. Will I say it's my asset? No, because no, it's not going to earn me any cash. It's not going to blast only. And I should be in a position to measure very reliably. So if both the conditions do fulfill, and if that happens to be a PPE, which is tangible, because if you see CM2 conditions will come for intangible asset also, plus one more condition, then probably I might have to recognize as an intangible asset, not as a tangible asset, not as a PPE. It will go to a separate line of item of the balance sheet. Are you clear? Simple, no? So many big definitions there. Here so small definition. Afterwards it will be simple. Okay, after some time. Up to some time you have to bear with me to understand. Now how to measure it? Simple. Measure at cost. No fair value, present value of the future cash flows. Now there can be certain scenarios of the PPE acquisition. You may acquire it by deferred payments. You will not pay full money. You will pay only, you will take it in installment. How should I account it? What is my cost in that case? Probably one finance cost is fitting there, no? Like you buy one asset in EMI. Then what is your cost? Now there is one interest element. You may have to separate it because that is a finance cost. That's not your asset cost. It can be possible you may exchange in a barter. Like you go and buy one car. How do you buy your car? You exchange your old car. Because of the old car, your new car cost will get reduced. So what is the cost at which you are going to recognize the new car? What you paid or the exchange value also? Whose fair value I should consider? The third, if you do construction or outright purchase, what is the cost? Interesting, no? You have to think, no? Because tomorrow we will come across this, Baba. Everywhere we will see this. So let us talk about the deferred payments. That means if at all you do the purchase, because this is the normal situation, okay? This is 99%, 90% of the scenario. This is 5% of the scenario. This is 5% of this. I can say. Or I can say, when you talk about purchases, deferred payment is sitting inside purchases. I can say that also. Now, if Ind AS 16 says that the cost of a BP is the cash price equivalent, that is fair value. Right now, if I pay the cash, how much I need to pay? Generally, when somebody offers you credit, that credit price is more than the cash price or less than the cash price? It's always more than the cash price, no? Because see, given an option to anyone, okay, you pay right now or you pay after 1 month. First they will ask you, okay, how much I need to pay right now? 100 rupees. After 1 month, 100 rupees. Okay, I'll pay for now because I'm a finance person. Finance person will try to defer the payment. So now, if that cash price equivalent is always low, you first focus on that cash price equivalent that you should recognize. What is this cash price equivalent? Present value of the future cash flows. And the differential amount is the interest. No, don't treat it as an asset. Take it to unwind it. Because what you have done is the present value of the future cash flows. Unwind. Unwind means amortization schedule, interest cost. We will see that. And in one of the questions we have done in Ind AS 109. Financial asset you purchased, 25,000 you paid, 15,000 pending. That 15,000 you found out the present value and unwinded that 15,000. That every year you charge the interest, same concept. Now what if you exchange? Very important and interesting thing. If the PP is exchanged with a non-monetary asset, what is a monetary asset? Cash. The cost of the PP is measured at a fair value. They say that, look, if you are going to exchange, then the fair value comes into picture. Because it's not, if it's exchanged for a monetary asset, then I don't have any headache. Monetary amount is fixed. Like I gave my car, that person paid me 50,000 rupees. What is the consideration? 50,000, finish. But I gave my car and he gave me his van. In my balance sheet, book value of my car goes. Van comes at what value now? Did I incur any cost? No, but I exchanged it. I exchanged a jet for my land. Then the standard says, look, the asset what comes in, it should be at a fair value unless the exchange lacks commercial substance. or you cannot measure the fair value reliably. That means of both the assets. If you don't know the fair value of the, see, understood the question now here. I have got one car, okay. I exchange this car for two things. Okay, this is my bike. Simple drawing. There are two scenarios. I will give this bike and get one upgraded bike. Or I'll give this bike and get one house. Now, why leave it? That bike may be Yamaha HD 450, once upon a time, valuable, whatever it is may be. Somebody wants my bike, they will give me two offers. Now, book value of the bike goes. Now, one new asset comes in my balance sheet. Now, at what value that new asset should come? The standard says that, look, is this exchange has got a commercial substance? What is commercial substance? That means what cash you are earning earlier versus what cash you earn with the new asset. Is it substantially same or different? Now, in the first case, you say, sir, I exchange bike for bike. What cash I used to earn with the bike versus what I am going to earn with the new bike. Little here and there difference is there, but not that substantially different. Then I say that this commercial transaction has, transaction has got no commercial substance, no commercial benefit there. But what cash I can earn from the bike versus what cash I can earn from the house, totally different, no. I say this has got a commercial substance, this has got no commercial substance. If this transaction has got no commercial substance, if you cannot have a commercial substance, then recognize the new asset at the book value of the old asset given, no profit, no loss. Old asset goes out, new asset comes in. What has come? Bike. What went out? Bike. Both are different, not different. So recognize it. But if at all, what comes? Yes, sir. So now if in case the cash what I am going to earn with this house, since it is substantially different from the bike, I cannot recognize at the book value of the assets given. I have to recognize at a fair value. Now, which fair value? That we will see now. That's why standard says that if you are exchange for a non-monetary asset, monetary you don't have any problem, but non-monetary you have to asset, you have to recognize the fair value unless it lacks commercial substance. If it lacks commercial substance, book value of asset given up. Or you can't measure both the fair value now. This also fair value you cannot measure, this also you cannot measure. Then house has to be recognized at the book value of the bike. Have you understood this? Okay. Now, if you can measure the fair value, if you have to measure the fair value, then which fair value? So this is the chart I have given you. If its barter is going to happen, first check, is there any commercial transaction? No, book value of the asset given up. No P&L. Yes. Can you measure the fair value? No. Book value. Yes. Then fair value. Now, commercial substance meaning is what? See the language of the standard, but it is simple. It says that the exchange transaction is considered to have a commercial substance if the configuration, hi-fi English word. What do you mean by that? Risk, timing and amount of the cash flow. It's called a configuration. One word they explain to use the configuration of the cash flow of the asset received, house, differs from the configuration of the cash flow of the asset transferred. Or the entity specific value of the portion of the entity's operation affected by the transaction changes as a result of exchange. That means, okay, you get house. What you will do with that house? That's called the entity specific value of the portion of entity's operation. Are you going to use that in your operation and enhance the value of the cash flows? Or are you going to keep it idle? Like bike also you kept idle, house also you kept idle. So it's going to change. So if the difference in 1 or 2 is different, that means because of this house, your operations change substantially. Yes, there is a commercial substance. Because of this house, the cash flow changed substantially. You might have exchanged bike for bike, but the new bike is going to give you such a brand, your cash flows increased. Even there's a bike for bike, it's a substance. Then you call it a commercial substance. If it's a commercial substance, then a fair value. No commercial substance, book value. You remember this, to repeat this in the examination. There is one question where they ask you on this commercial substance part. Now, which is the fair value I should consider? So if you can measure the fair value of the asset given up, say bike, whatever asset you get, measure at the fair value of the bike. No, I don't know the value of the bike. Check. Do you know the fair value of the house? You don't know the fair value of the bike. Do you know the fair value of the house? Yes. Then you recognize the fair value of the house only. When you say, sir, I don't know both, then book value, go top, book value. I know both. Then you have to give priority, no? Give priority to the asset given up. What you give up, its fair value should be given priority, not what you receive. But if you see Ind AS 115, this is opposite of 115. In 115, fair value of the asset received should be given priority. Why? Because you are a seller there. Here, you are not an asset seller. There is a business of someone. 115 is selling somebody something, no? That's regularly what I do. But here, selling of PPE is not my business, no, Baba. Selling of PPE is once in a while transaction. That's why I should always give the priority to the asset given up. Clear? There is one or two questions here. We will solve that. Theoretically, okay. So we will discuss one more thing on the cost. With this, we will solve the question and we will move on to the subsequent measurement. Now, what if I purchase it or what I construct this house asset? Then the standard says, look, for the initial measurement, you have to include three costs. One, the purchase price you have to include. Now, you will ask, sir, what is purchase price? Whatever price you pay to the vendor. If you have paid any import duties which is non-refundable to you, like GSTs, taxes you have paid which is not refundable, this, that is also part of your purchase price. If it is refundable, don't include it because it is not your cost. Then, did you incur any cost directly attributable to bring this asset for the use? Because unless you use it, you can't earn the cash. So, did you incur employee cost, site preparation cost, delivery, processing fees, cost of testing? Okay, less proceeds from the sale of product, like some scrap sales, something happened, small test sales and all, that you can deduct. But until it is ready for use, that's it. Whether you use or don't use, that is secondary. Depreciation is going to charge from that day. So till that time, whatever cost incurred, you have to capitalize it, including borrowing cost. I would have done the borrowing cost before this, but I thought only one or two applications come, that I am shifting it later. Then the third is, look, the day you got this asset, one thing you have to see, do you have got a dismantling cost? What is dismantling cost? See, you do some, what is that called? At home, did you play that house game and all? Cooking game? You played no at home. Then you're a small kid. And you all bartan, this, that and all you will bring from the kitchen. First, only one instruction comes to you from your mother. What is the instruction? You play whatever. At the end of this session, it should be clean. You can't run away keeping it there. And if you run away, what happen? One shot, no, in the back, on the head, on the ears. Correct? So this is called dismantling cost. And when did you incur this dismantling? When you got into this obligation? This is coming at the end. Your certain actions right now created an obligation on your head. You don't take a vessel, you don't have any obligation. You took the vessel, you got into an obligation. Now comes Ind AS 37. So on day one, you have to make a provision to it. Maybe among yourself, you should give this responsibility to someone, okay? It's your responsibility. At the end, you should do it. So the credit leg you have told, where is debit leg, Baba? Debit leg is your PP. So accounting entries, PP account debit. Ind AS 16 to provision for dismantling cost. Ind AS 37. At what value? Present value of the future estimated cost. But this is not a financial liability. But this is an obligation for you. Followed, no? And this is what exactly we are going to do in Ind AS 116 also. So these three are your component of the cost. Other than that, you don't do anything. So what is this cost which is not part of the PP? The cost of conducting business in a new location. You shift one place to another, train the staff. That is not the part of your asset acquisition. Asset was ready for use. Cost of introducing a new product or a service, opening a new facility, administrative overhead cost, selling and distribution cost, abnormal amount of the wastage of the material and all. No, you don't do abnormal, you bring it to the notice of the investors there. Don't capitalize and sit nicely. If you have made incurred abnormal cost, charge it to the P&L. So this is all about your initial recognition and measurement, but you don't have a breakup. Like we discussed initial measurement recognition for financial assets also, but financial assets separately, liability separately we did. Here nothing, here's one. So we'll solve some problems. With this we get a better understanding over the concepts. No, staff training if you are going to do, no, it should not be part of your PP. Okay, so that part should be charged to the P&L account. Okay, you move to the conduct the business to a new location, you train the staff for doing it. See, point here is that asset ready for use? When you do staff training, that is when, before or after? It is for earning the cash. No, it's your day-to-day operational business. Now, is that training necessary to make the asset ready for use? No, the installer, somebody would have come, he would have installed it. It is ready for use, that's it. Then he will train you how to operate it. That is your operational. No, if that is permitted, then you say lifelong training is going on lifelong. Will you capitalize every time? No, we need one cutoff point. No, that's why they said staff training, you don't include it. It is after the asset is ready for use. You bring one washing machine, same story. No, up to install, he will show. Then you have to pay him. Then training, we mess it up. That is a different story. Yeah, good. Which one? Trial. Trial we can add. Again, this trial part we will see in Ind AS 38 also. Trial part because it is needed. No, like he will come once he switches on and runs one trial to see whether it's working or not, because it is part of the asset being ready use. Without that trial, he cannot say that, oh, it is ready. Like you go and buy a mobile, he will switch on and show it to you. It's a trial. Then again says, don't use it, full charge and then use it. Again, please open up your mind. Look here and there, not here in the room, outside. Open up your inner eye. Look into your article shape. Look at the clients. See what you have come across. What happens, how the accounting is going to happen. I'm telling you, this subject is going to open one different world to you. How, because 115 and all is going to blow your mind. I don't know how it's going to. For me, it was a mind-blowing experience studying 115. Because everywhere I can see 115 only. Okay, so we will start with the Q&As. So first scenario we will start called the deferred payments. Take out question number 1. It's an illustration question. It may come for 5 marks. On 1st of April 2011, an item of PPE was offered for sale at 10 million rupee, 1 crore. How much you have to pay? 3 installments, 33 lakhs. When payments are made on 1st of April, right now one down payment I need to make. And then the 2 more installments I'll pay at the end of first year and end of second year. It's not that right now I didn't made any payment. 1 EMI right now, then 2 EMIs. And how much is the rate of interest sitting here? 5.36. That means if I pay in cash full amount, so because I end up paying how much? 33 lakh, 10, 1 crore. But if at all I would have paid full money, I would have paid less than 10 crore. No, right now. Nobody can tell you, no, you pay 10 over a period of EMI also, or if you want cash payment, right now you have to pay 10. You will never accept it. You say, sir, if I have to pay right now, give me cash discount. That discount is nothing but the interest portion, which is 5.36. Show how the property will be recorded as per 16 and be careful, pass the necessary journal entries. Okay, so we'll write the solution, because how it is accounted we need to explain, no? Ind AS 16 require cost of PPE to be recognized at cash price equivalent on deferred payment. Understood? Cash price equivalent concept doesn't come if you are not doing deferred payments. If you pay right now, that's a cash price. That's a cost price for you. It always says that, look, you always go for cash price equivalent. That means right now if you pay, what is the amount that? Hence, we need present value of cash flows. Yes, so we will do the calculation. So first we will write the theory here. So we are going to calculate the cash price equivalent. Okay. So what is the cash price equivalent? Right, heading calculation of cash price equivalent. So cash price is equal to 33,33,333. This is payment at time now, right now, plus next 33,33,333. When do you pay? At the end of first year. So its present value is 1.0536 to the power 1. This is 1. 33 lakh right now you made in time 0. This is the present value. I am trying to find out the present value of the future cash flows. 1 divided by. This is the same. Or you multiply with the present value factor, 1 and the same. Plus, so I am just changing a presentation here so that this is faster. 33,33,334, 1.0536 to the power 2. If you solve this, see, I have presented it like this. If you want, you can do it this way also. See, if you want a traditional way, the cash price equivalent comes to 95 lakhs. So with this, can I pass one journal entry? What entry I am going to pass? PPE account debit, how much? 95 lakhs. To bank, how much? 33,333. 33 lakhs, 33,333. To vendor. What is the vendor? Balancing 61,66,667. Now, if this you look into it, no, it is nothing but the present value of these two values, which is nothing but a financial liability for you. Contractual obligation to pay cash. How did you record this financial liability? At a fair value. Why? Because this contract was at a fair value. Otherwise, one more element would have come there. If it is an off-market instrument, you would have found out the fair value of this person separately, and there would have been one more difference come. 95 lakh is the cash price equivalent at 5.36. But the off-market instrument, that means one more. Now you have to see L1, L2 input and all. Anyhow, they don't expect you to. Now what should I do? Subsequently, interest cost is recognized and you start charging depreciation. Subsequently, this is the initial recognition. Subsequently, depending upon the life of the asset, you start charging depreciation. And for this financial liability, it is the present value of the future cash flow. You prepare unwinding of the discount. So, we will prepare one amortization schedule. Is it okay? Clear? We prepare one amortization schedule. year, end of the first year, end of the second year. Because by second year it's going to get finished. What is your opening balance? 61,66,667. How much is my interest at 5.36? 3,30,533, correct? Is there a cash flow? 33 lakhs, 33,333. What is your closing balance? 31 lakhs, 63,867. If financial instrument chapter was not done, you would have asked me, sir, what is this we are doing? Where is this interest? What we are trying to do it here? Baba, we are doing it because there is one leg of interest element sitting. At a present value, what is the implicit rate? No, implicit rate means IRR. That is called implicit rate. Means what is hiding in this transaction? So second year interest is 1,69,467. 33,33,334. We have to put a star and enter that difference amount. Balance is 0. Yeah, 1,69,467, whatever. Now I need to pass the journal entry. Okay, so like I have provided it like this. I started with the opening balance minus this. Okay, need not do this way. You can just take, we always in all the amortization we start with the year end balance. Here there is the confusion because the first payment is paid at the beginning. Followed, no? Yes. Now this journal entry we have passed. At the end of the year, I need to pass interest expense account debit to accounts payable to bank. Accounts payable to bank. This entry is simple. We know now where to pick this entry. We'll pass one more entry at the end of second year, and then we'll pay the vendor. Yeah, we have paid the vendor and finished everything. Will I pass depreciation entry? Yes. But I can't pass here. Have they told you life? No. Then if I don't know the life of the asset, I just theoretically write here that we will charge depreciation. We will theoretically tell. We will charge depreciation. But I can't do it because the life is not given to me. Otherwise, one more depreciation entry also would have come there. Life minus scrap by, cost minus scrap by life. So you understood, no? Whenever deferred payment happens, how you need to do the accounting. First, you need to figure out the present value, cash equivalent, which is nothing but the fair value. Separate that fair value and account it at a fair value, and the financial liability should be recognized at a present value. Then going forward, it will be an interest expense. Previously, this cost in maybe provided was sitting in a asset. Now it is not sitting in asset. We separate it. And what is this 3,30,533 plus 169,467? It is that 5 lakh rupees interest, which would have got capitalized. Now accounting is a very clear picture, no? Yes, with this, that's only one question was there. Let us talk about the exchange of the assets. We discussed this chart, check for commercial substance, check the fair value and all. Then if fair value priority also we have understood, always give priority to the asset given up, no received. Both are available, given up. Both are not available, book value. Question number 2. Pluto Limited owns one land and a building which are carried in its balance sheet at an aggregate carrying amount of 10 million. Now, the fair value of the such asset is 15 million. The market price of this building and land and building 15, but your book value is 10. It exchanges this land and building for one private jet, which has got a fair value of 20 million. His book value we are not interested. The seller's, what is the book value in the seller's account? And additionally, you pay 3 million cash. What is my journal entries here? What is my accounting treatment? No. Okay, so what is the value? Okay, first we will pass the journal entries. Private jet, how much? But both are available, no? Yeah, fair value of the asset given up. What did you give up? Ah, that is also fair value, no? Cash is also fair value. So it's 15 plus 3, 18. 2, land and building, 10. What goes out is a book value. Bank, 3. Differential, P&L. Okay, but there are how many questions? 2 questions are there, no? And they have used no. Be careful. So first we have to write necessary treatment solution. Assuming, because do we know whether private jet and the cash flow, because configuration test and all we have to perform. Assuming the transaction has commercial substance. We don't know how much cash this is going to give me, how much their asset is going to contribute in my operations. I don't know. Assuming substance. The entity shall recognize jet at fair value of asset given up and recognize P&L on transfer. So you have to recognize the P&L. So do we have a profit or loss? P&L on transfer. One working note we can prepare. Fair value of recognition 18 minus book value of the asset given up 10, cash 3, 13. So your gain is 5, which is very evident. 15 minus 10. But you have to present one working note. Are you clear, students? So first you write this theory and then you give one working note. With this you do the accounting and then you pass the journal entries. It may sound simple, sir, all these values we know, no, can't we directly pass the journal entry? But my point here again here is they expect you to write, and what verbs they are going to give you, I am not sure. And it should be worth 5 marks. No, journal entry may not, one journal entry they may not fetch 5 marks. So it requires some working note to prove it, demonstrate it, what you understood. Yes, the journal entry will be, already we discussed, private jet, land, bank to PPE, profit and loss. Done? I think only one question. See, this question is come from the another chapter, okay? Ind AS 40. Just since we are discussing here, we will have a better understanding. We need not solve this because again we are going to cover that. Sun Limited acquired a building in exchange of a warehouse whose fair value is 5 lakh and payment of cash is 2 lakh. The fair value of the building received by the company is 8 lakhs. The company decided to keep the building for rental purpose. That's why it becomes an investment property. Ind AS 40 becomes applicable. If you rent it to your employees, PP. How the entity should account the above transaction? What is my journal entry? Can you tell me the journal entry, students? Sorry, debit what? You say investment property. Building. Acquired a building in exchange of what goes out is a warehouse. What you acquire is a building, which is investment property. To building. At what value? Building is 7 lakh. Fair value of the asset given up plus the cash given. That means 2 cash is there. 2 lakh. Then not given. So since the book value of the building is not given, what you make an assumption that fair value is given, no, they must have revalued their asset, and whatever profits, no, they would have taken into the P&L or OCI reserve there only. So the accounting entry will be investment properties expired, fair value is given, presumed to be equally important. So you have to, all those theory stories and all you have to write. Give priority to the fair value of the asset given. A previous question also, this all theory were missing. That which one you give priority. In the previous question, why did you take jet building fair value? 15, why did you take? Why you didn't took the fair value of this? You didn't explain, no? In the previous question, why did you took 15 as the fair value of this PPE? Both were available. Why you? That's why you have to explain that. That's why this theory is meant for explaining. Look, I am going to give priority to this. Depending upon marks, you have to explain that. This question can come for any marks. They may mix it. That becomes a conceptual, and ultimately you are going to give this journal entry. Pretty clear? This journal entry. Now below is important. Refer illustration 2 of Ind AS 16. Okay. Next, not illustration 2, some illustration. If the fair value of the property acquired is more clearly evident, then the fair value of the assets acquired is considered. So if it was, chalo, if at all they give one information that the fair value of the building is more evident than the warehouse, entry same, no? To cash, I will help you. How much? 2 lakh. To PPE, how much? 5 lakh. Now the fair value of the building is evident. Question is clear? Then what standard says? Consider the fair value of the building. Now what is my debit? Is it 8 or 8 plus 2? Question is clear? See, it says that you have to consider the fair value of the asset given up or fair value of the asset received. Among two, if both are clearly evident, give priority to one. If one is more clearly evident than other, you have to give priority to that. Now in this question, they are told building fair value is more evident than the warehouse fair value. Then you have to give priority to the building fair value. Now my question is, will you enter 8 or will you do 8 plus 2? 8. Followed, no? Because when you talk about fair value of the asset given up, it includes 2 assets together versus 1 asset which you receive. Keep in mind, this is concept. They may, right now, don't worry. What if they twist it? That's why you should know what I am doing. Because of this, I get one gain on sale. Previous question, there was no gain on sale. Your assumption was it must have done revaluation. Yes, done. I mean, finish. Simple, no? Now we will go to the purchase. Very important. Majority questions. Nice questions. Simple questions also. On 1st of April 2011, XYZ Limited acquired a machine. Now I will take back you to your enter, okay? List price of the machine they have given you, import duty they have given you, delivery fees, electrical installation, pre-production testing, purchase of a 5-year maintenance contract with the vendor. Now in addition to the above, they have granted one trade discount of 10% on the list price. Is it part of the cost or no? Means should I deduct or should I not deduct? Deduct, because it is trade discount. And a settlement discount of 5% is given. No, it is a subsequent to the asset ready for use. And payment of the machine was received in, if the payment was received within 1 month. XYZ paid on 20th of April. You 1st April only you took. At what cost the asset will be recognized? Just tell me, students. Okay, please pause the video. Students, again, there is nothing I should teach you here. Tell me the total value at which it will be recognized. And you do the working. First thing, in this list, is there any item which is not part of the asset cost? See, what I am going to capitalize is something which is directly incurred to make the asset ready for use. Is there anything which I am going to ignore? Maintenance. Other than everything is part. Trade discount is always part, list price. When I talk about list price, I am going to deduct even trade revenue recognition also. But cash price is something subsequent. It has nothing to do with my asset being ready for use. No. When the asset is being ready for use, the trade discount is always part of that. Now, when you pay right now, after some time, doesn't matter there. Because by that time, the only trade discount will be considered. So you have to give the explanation for that. So first you say that historic cost is so much, trade discount is so much, you include this 5 cost, prepaid expenses are not part of this, you say 92 lakhs. Yes, what went, what you incurred? You included as part of, no, it's not part of my capitalization. No. It will go to P&L account as and when you pay the maintenance, you charge, because you need that maintenance to maintain the asset. Now nothing, did you pay anything? Okay, if you have, then it's prepaid. What is your accounting entry? Now tell me what is my accounting entry here? My accounting entry is PPE account debit, 92 lakhs. Prepaid, whatever maintenance cost, 7 lakhs to bank. Look at the journal entry, which they didn't ask you here. But that PP92 is supported by this working, which tomorrow auditor is going to ask you. He's going to ask you, okay, is this directly incurred to bring this? No, then why you are incurred? Take it to P&L account. You can't include any other thing there. And this cost will be distributed over the life of the asset. Ultimately, everything is going to come in the P&L. But not right now. Something is you are going to incur in the future. Charge then and there in the future. Sorry? Pre-production testing. I told you, no, you ask one washing machine, the person will come and install it. Will you not switch on, do one round and say, okay, look, madam, your washing machine is ready. There is one cost included in that pre-production run. No? It is to test whether my asset is ready or not. Without that, I cannot say. So that's part of my cost of the asset. But a post-production, no. Next time you put your clothes and wash, no. That's part of the maintenance. You are going to use that asset. Pre-production will become part of the asset. Clear? Yes, I'll proceed further. Anyhow, you understand. But very importantly, look at the question. What question is they have asked? At what cost? They didn't ask you explanation, analyze, note. Otherwise, every single place you have to explain why it is part, why it is not part. Here we will give as a note. Look, for all things, directly attributable cost will be part of the, to bring it to the working condition part. 5-year maintenance is not cost because it is not operational. Settlement discount is not going to be part, it will go to the P&L account. With this, your answer is complete. Somebody will come to know why you included, why you didn't include. Okay, so you can leave some space, we can enter it later. Now, X Limited started a construction of a building for the own use. The following costs are incurred: price of the land, stamp duty. Is it part? Yes, because without this, they will not permit you to start the construction. Architect's fees, site preparation, material, labor, general overheads. No, because these general overheads you cannot load it on the cost of the asset. Then you have got other relevant information. Material costing 1 lakh out of this total 10 lakh what you have spent is spoiled, therefore wasted. You can make an assumption it's an abnormal. Further 1,50,000 was work spent. That means labor whatever you spend, no. Out of that 1,50,000 was spent on this faulty work. As a result of the work of the building stopped for 2 weeks and estimated that 22,000 of the labor cost related to that period. Sorry? 22,000 is an abnormal because of that abnormal stoppage. The building was completed on 1st of January 2011. When did you start? 1st of April 2020. You started construction. Maybe I will tell you from time to time about Ind AS 23 borrowing cost capitalization. Since you had no intermediate level. So we know that the borrowing cost capitalization starts from when? From the time you acquire the land or when you start construction. So if you have acquired a land, you have not started construction, land is not a qualifying asset. Why? Because the land is ready for use. If you keep it vacant, you cannot capitalize. But if you have acquired and started construction, then you can capitalize it. Now, when it's going to end, the moment of production work ends, you have to stop capitalization. So building is completed on 1st of January. When you bring it to use, you live. On 1st of January, two things happen. Depreciation start, borrowing cost capitalization stop. In detail, we will discuss in that standard. Like in the borrowing cost also, there is a specific borrowing, there is a general borrowing. Is that coming from where, what? We'll go there in detail. After it's ready for use. Income tax is a different discipline. Income tax may say that if you have used less than 182 days, you will give whatever percentage and all. On that, deferred tax is going to come now. Ind AS 12. When we talk about accounts, we will talk only about accounts. Income tax, we are not concerned. When deferred tax concept comes, we will see what it is. Maybe in the multidisciplinary, right now, not right now, after 2 years, then you have to think what my income tax act says. How they look at it. And income tax is always what happened, no? They say add profit as per P&L account. So they just ignore what you did. And then the adjustment as per their act starts. So first which subject comes? So always students, when learning also, if you are looking, first AFM is the subject first you should learn. Independent. FR is the second one. Because FR depends on AFM. DT third. No, you can learn anything, doesn't matter. Then what happens? DT depends on FR. They say FR add back. Then your DT starts. Somewhere you have knowledge before, you can try to bring that. But that goes in that flow. Followed, no? Anyhow, not relevant. Multidisciplinary, it may be much relevant, interesting. Now what happened? X Limited taken a loan of 40 lakhs on first only. Be careful there. Here they will give simple example. But in Ind AS 23, we will learn example that you took the asset first, loan later. Loan was already there, asset you brought later. This type of scenario for construction of the building. It's a plain case. On 1st April only you took one loan. Is it a specific or general loan? Specific. So whatever borrowing cost you incurred, you have to charge. The loan carried interest rate of 8% and payable next year. Calculate the cost of the building that will be included in the tangible non-current assets as part of your whatever your asset. Follow? Yes. So we will do this problem, calculation of the capitalization cost with the explanations we have to give. So we'll write first cost. Land price. Will you include it? Yes. You are going to include the land price. Stamp duty. Did they ask you explanation? Analyze? Nothing. So I'll just calculate. So question is very simple. Calculate. No explanation there. Maybe I'll give the explanation later. But if they say analyze and all, then next column I should explain why I'm including land. Be careful. Otherwise you will lose the marks. 2 lakh. Architect fee. 2 lakh. Site preparation. 50,000. What about the material cost? 10 lakhs. 10 lakhs, no? Minus how much 1 minute? 1 lakh is loss. Because of that, to set it right, additionally how much did you spend? So total how much is your abnormal? 2,50,000. It's like one chair broken, material lost. Now to set it right, you brought extra clamp and this, that and all. So 2,50,000 is your abnormal material cost. Followed, no? Where they said. And further, 1,50,000 was spent on account of faulty design work. So it is a and with the first sentence. Subject matter of assumption, you can say, okay, wherever it is it abnormal? Abnormal. So you left to you whether you deduct from the material cost or whether you left deduct from the labor cost. You deduct it. I will say it is the material cost only. So it comes to how much? 7 lakh 50. Labor 4 lakh minus 22. So if you say, sir, that previous 1 lakh 50 was the labor cost I incurred, you say 1 lakh 50 plus 22, 3 lakh 78,000. Are you going to include general? No. Are you going to include the borrowing cost? Yes. How much is my borrowing cost? Borrowing cost is charged on the total value of the capitalization or on the borrowings. That depends upon, okay, your whether it is a general borrowing or special borrowing. If it is a general borrowing, you take a capitalization rate. I am reminding you, okay, we know it already. You take a capitalization rate and apply on the bills what you actually spent. If it is general borrowing, you apply it irrespective of what you spent on the total value. So you took 40 lakh loan, and question seems like it's a special borrowing. Into 8% you paid. Is that amount I am going to borrow? No. You start the capitalization from first. Can I capitalization on the land? Obviously, because the land and the building construction work started together. Into 9 by 12. So you have to go more deeper, figure out what happened there, what I can include, what I cannot include. Maybe another question, capitalization works differently. It is a different assumption. Because Ind AS 23 has not defined 12 month. AS has defined 12 month. So it is a subject matter of assumption. Somewhere study material they assumed 7 month is substantial. Somewhere 9 month they assume not substantial. You are going to find now. Don't get confused. Follow? Yes. Now we will explain it. Notes and assumptions. 1. Only directly attributable costs are capitalized. Therefore, general overhead is not included. If it was a special or specific overhead, like depreciation of the office building, no. Depreciation of the plant building, yes. Specific overheads, I am going to add it. General overheads, I am not going to add it. Second, depreciation of the office equipments, no, it's a general. It's a specialized plant equipment, yes, it's a specific. Like you wanted to install it. For this, you used one bulldozer. Without using that bulldozer, you cannot install it. Now, can I charge the depreciation of that bulldozer? Because for this, for your purpose, that bulldozer was kept vacant for 1 month. I will load that cost on this. No, that's permitted. Cost of spoiled material and labor are abnormal, not included. So as per Ind AS 16, we are not going to include any abnormal cost. So we say that, okay, it is assumed labor cost is also abnormal, not included. We can give some general explanations. Are you clear? Yes. ABC is installing a new plant. Cost, delivery, cost site, consultants, indirect charges paid to the supplier for deferred credit, net present value, operating losses. Please advise whether what amount can be capitalized. Yes, students, please pause the video and do this. Let us check. Yes, students, how much is the total cost did you get? 45, 45, 45. Yes, yeah. In total. So very happy everyone, correct? No, 45. Every friends also got 45. But what did you do with this deferred added? What is this? Don't tell me that you don't know. So this is what we started with now. Interest expense will go where? What did we do then in the first entry? Prepaid? Did you thought about this? No. Huh? You thought about it. That means you didn't pay upfront. Deferred payment means you didn't pay upfront. That means you must have recognized present value of the future liability. And one of the EMI you paid during this year, that EMI has got two components. That's the finance cost, no. When you pay, obviously in the first entry, when you paid 33,33,333, was there a two breakup there? One leg will go to finance cost and what did you do with that debit? Did you do debit interest cost? First problem, what did you solve? No, that interest cost, what did you do? Asset account debit to interest cost you did, or P&L account debit to interest cost you did? Then why you are doing it here, asset account debit to interest cost? Can you capitalize this? No, because asset is ready for use there. You incur this after. Hello, no? Installing a new, that means you have installed it, into the production. Now, operating losses before commercial production, what did you do? Left it, very good. See, there are two things. One is called a trial. It should be part. But once the asset is used, initial days there is a lot of inefficiency. People don't know. Followed, no? Then they will do some trial error and all, they will make a lot of mistakes. No, that cost you cannot charge it to the asset, because asset was already ready for use. And after this you get one capacity for a commercial production, you go full-fledged. That anyhow, after it is ready for use, it is not going to come. So your capitalization will be cost of the plant, initial delivery, site preparation fees, net present value of the dismantling cost. We explained dismantling once upon a time, you have to do it. Its present value. So 43 is the correct value. Whatever it is deferred payment, today's day, that material cost at what value you will recognize? What is the entry you pass today when you purchase through a deferred payment? You do cash price equivalent, material cost account debit, cash price to party, present value of the future cash flows, no. And whenever you pay that EMI, it has got one interest cost, but you can't capitalize because the qualifying asset is ready for use by that time. Then you can capitalize, no. If then you can treat that as a finance cost. Yes, if you are still under construction phase, you purchase a material on credit, that there is one element of finance cost, very good, and then that will, you can capitalize it. Now in the question, is it under construction or under already site preparation? It's a installation. That means your assumption may not hold good here. If it was under construction, you could have assumed and you could have capitalized it. Understood? Yeah, and you write some true theory that payment is deferred to be not to be capitalized. Return to P&L. Why? Assuming your asset is ready for use. Otherwise, Ind AS 23 says that finance cost includes your this cost also. All finance cost, not only this exchange rate differences and all. It will tell so many things there. Lease payment, it's called a lease payment. In lease accounting, we are going to come across finance cost now. Are you clear?